Bitcoin is down 1.5%. Your gains just got wiped before the week even started. Monday, August 10th, 2026. Like and subscribe for daily market updates. Today's agenda: market snapshot, oil surge explained, crypto regulatory delay. Up next, oil surge explained. Let's get straight to where things stand right now. The market is digesting early price swings driven by shifting macro expectations. Bitcoin sits at $63,862.39. That marks a significant drop of 1.5% from its open session price. Why did it fall? Growing risk aversion among institutional traders caused the move. They are recalibrating exposure ahead of potential Federal Reserve commentary. Could tighter cash flow follow that speech? Ethereum sits lower still, down 2% at $18,732.32. It struggles to find support as altcoin momentum fades alongside broader tech sector hesitation. In contrast, gold climbed slightly today, hit $414.60 for a gain of 0.75%. Investors flock there when equity uncertainty rises. Historically, this defensive rotation often precedes larger corrections in risk assets like cryptocurrencies and growth stocks. Meanwhile, oil surged dramatically to $87.04 Brent and $81.46 crude oil. That is up over 4% in just one session due to unexpected supply constraints from major producers cutting output unexpectedly or global political tensions disrupting key shipping lanes. The dollar index ticked up 0.2% to 99.75 as strong U.S. economic data reinforced the currency's appeal against weaker global peers. For investors, this snapshot suggests a bifurcated landscape where capital is fleeing speculative bets toward tangible assets and hard currencies while waiting for clearer signals on interest rate trajectories that will dictate next week's trading range. That energy strength contrasts sharply with what's happening in the crypto space right now. Crude prices surged 4.02% today. A potent mix of global political anxiety drives this move. Fundamental mechanics extend beyond headline news here too. You feel fear surrounding Iran's potential retaliation against the Strait of Hormuz. This waterway funnels roughly 20 to 30% of global seaborne oil supplies. Although recent diplomatic overtures suggest talks are underway with Oman, no official agreement has been signed yet. This lack of a concrete resolution creates an information vacuum for everyone watching. Markets price in worst-case scenarios rather than optimistic outcomes right now. Traders aggressively purchased futures contracts, not merely as speculation. They bought them as essential insurance against sudden supply shocks. These shocks could trigger cascading inflationary pressures across the global economy. Historically, this dynamic mirrors unpredictable price swings seen during the 1973 oil embargo and early 80s Iran-Iraq war tensions. Mere rumors of conflict caused price spikes disproportionate to actual physical disruptions back then. Markets anticipate second-order effects like shipping rerouting costs and skyrocketing insurance premiums today too. When uncertainty lingers without a definitive timeline for de-escalation, risk aversion dominates investor behavior immediately. Capital flees stocks and flows into hard assets or energy futures as a defensive hedge instead. You see this shift clearly in the data. For investors holding positions in major oil producers or trading energy derivatives, this move provides immediate portfolio protection. It locks in higher prices for expensive assets relative to earnings, reflecting the elevated cost of doing business in unstable regions. However, it also introduces significant downside risk if global political tensions unexpectedly de-escalate faster than anticipated. This could potentially lead to sharp corrections as the fear premium evaporates overnight. Consequently, while these price jumps offer a buffer against supply-side nightmares for energy portfolios today, they simultaneously expose holders to rapid valuation swings too. These swings depend entirely on diplomatic breakthroughs or fresh intelligence reports from the region that could instantly alter market investor mood. Will you hold long positions when unpredictable price swings force liquidation? Some traders cannot tolerate such volatility at all. But wait, there is another factor that might change everything for risk assets, globally speaking across borders worldwide, including small businesses struggling with debt service payments, monthly due dates approaching quickly soon. Bitcoin's recent price correction stems directly from a significant trigger failure over the weekend. Planned legislation ground to a halt in Congress. The United States Senate failed to pass its comprehensive crypto regulation bill, before recess arrived early this week, leaving markets exposed once again. Lawmakers lacked sufficient votes amidst intense partisan gridlock and procedural hurdles designed by leadership to slow high-profile initiatives. Consequently, the legislative timeline has been pushed back until mid-September at the earliest, extending regulatory uncertainty that weighed heavily on prices all week long. This stagnation is not merely bureaucratic noise. It represents a critical failure in market infrastructure development. Historically, clear legal frameworks act as price floors for digital assets by reducing systemic risk premiums demanded by institutional capital. Without such clarity, traditional finance remains hesitant to allocate significant resources into crypto portfolios, fearing potential compliance liabilities or unfavorable future rulings. The mechanism is straightforward. The absence of a defined regulatory environment forces investors to demand higher compensation for holding unproven technology in an undefined legal landscape. This hesitation creates a self-reinforcing cycle where lack of clarity breeds unpredictable price swings, which further discourages institutional entry. For retail and professional investors alike, this delay implies that capital allocation strategies must remain defensive until the political calendar shifts favorably again. The market is effectively pricing in a prolonged period of ambiguity, suggesting that any genuine price discovery or sustained bull run will likely wait for concrete legislative action rather than hopeful speculation on future bills. Until then, unpredictable price swings remain structurally embedded into asset prices as participants hedge against potential regulatory overreach or restrictive enforcement actions emerging from the vacuum left by stalled legislation. That brings us to why gold is up. The U.S. 10-year Treasury yield stands at 4.70% today, marking its highest level since early September. Under current central bank policies, this figure establishes a formidable ceiling for global risk assets that investors must watch closely. When yields rise sharply, they compress equity valuations immediately, making assets appear expensive relative to earnings, while borrowing costs worldwide increase instantly. Higher treasury rates force investors to demand larger premiums over bonds before committing capital, causing them to pull cash away from stocks or real estate first. Growth sectors like technology and small-cap firms suffer most because these companies rely on cheap debt for expansion today. The immediate impact extends far beyond Wall Street. Small businesses struggle with monthly debt service payments as upcoming due dates approach under tighter financing conditions soon. Historically, this dynamic mirrors 2013 when taper tantrums hit hard following Federal Reserve signals that shifted expectations on bond purchases, causing unpredictable price swings to move through markets before stabilizing after months of rapid repricing of risk premiums. Today's sustained elevation at 4.70% suggests a structural change has occurred rather than a fleeting spike. The era of easy money has definitively ended for many borrowers already. For investors holding leveraged positions, this environment demands immediate caution, while those dependent on refinancing existing obligations must be careful too. Capital allocation strategies must now prioritize balance sheet strength over aggressive growth bets, because the cost of failure rises sharply when funding dries up globally, including in emerging markets facing currency pressure right away. Let's wrap this week by looking at what could happen if the Senate finally acts on crypto next month. Gold surged past $4,415 per ounce today, marking a strong quarterly rally as investors shifted capital toward hard assets. This move reflects a calculated flight to safety, driven by converging global political fractures in the Middle East and escalating fiscal tensions in Washington. As oil supply risks mount and diplomatic standoffs threaten regional stability, investors recognize that traditional paper currencies face unpredictable price swings when global trade flows are disrupted. Simultaneously, persistent concerns over unchecked government spending have eroded confidence in fiat central bank policy's ability to preserve purchasing power indefinitely. Historically, similar dynamics occurred during the 2014 Crimea crisis and the 2020 pandemic onset, where gold absorbed massive inflows precisely when stocks stumbled under global political or health-related shocks. The mechanism is clear. Uncertainty premiums are priced directly into precious metals because they offer no counterparty risk like bonds do. Unlike stocks that suffer from earnings downgrades during crises, gold's value often rises as a direct hedge against systemic chaos. For the average investor holding diversified portfolios, this signals an urgent need to rebalance allocations toward non-correlated assets before panic selling triggers available cash in the market crunches elsewhere. If diplomatic talks stall or new sanctions emerge next week, we could see further upside momentum pushing prices toward psychological resistance levels near $4,500. Conversely, a sudden de-escalation might cause short-term profit-taking, but would likely leave the long-term bull trend intact given current big-picture economic challenges. The takeaway is straightforward. In an era of rising global political noise and fiscal looseness, holding physical gold remains one of the most prudent defensive strategies available to preserve wealth against inflationary surprises or currency debasement events that could unfold over the coming quarters. Finally, let's turn to what to watch next. Wednesday's Consumer Price Index release is the single most critical economic event on the global calendar. This monthly inflation gauge dictates the Federal Reserve's interest rate trajectory, directly impacting capital flow into riskier assets like Bitcoin and stocks. If data reveals cooling prices matching expectations of 2.6%, investors may interpret this as a green light for potential year-end rate cuts. Such moves could fuel renewed crypto rallies by lowering borrowing costs and boosting available cash in the market. Conversely, any surprise uptick would force the Fed to maintain higher rates longer, reigniting fears that tight policy will stifle growth and push yields up. This dynamic creates immediate pressure on Bitcoin's valuation. Historically, it struggles when real interest rates remain elevated due to the opportunity cost of holding non-yielding digital assets versus government bonds. A second-order effect compounds these challenges. Regulatory uncertainty makes investors hesitant to deploy large capital without clear policy signals from Washington or regulators like the SEC. Fear persists that crackdowns could mirror past unpredictable price swings seen during previous cycles, when inflation spiked in 2013 and again in 2022. Historically, high inflation paired with regulatory ambiguity has resulted in significant drawdowns for early-stage asset classes until clarity emerges. For investors watching this moment, positioning requires assessing not just the headline number but its components and influence on the Fed's dual mandate. Those holding long-term Bitcoin must prepare for heightened, unpredictable price swings as algorithms react instantly to forecast deviations. New entrants should consider waiting until after the data clears unless their risk tolerance allows navigating choppy terrain, where big-picture economic underlying health and regulatory headlines collide in real time. Oil surged 4% to $87.07 as tensions near the Strait of Hormuz persist, despite quiet diplomatic talks with Oman that have not yet produced an official agreement. Bitcoin remains under pressure at $65,000. It requires yields below 4.6% or regulatory clarity from Washington before mid-September to reclaim its support level above $64,000. Meanwhile, gold continues climbing as a safe haven amid Middle East uncertainty and stubbornly high inflation that the Federal Reserve aims to reduce without triggering a recession. Markets await further developments next week for potential stabilization ahead of small businesses facing upcoming debt payments globally. Thanks for watching Market Pulse Daily.